Hi everyone. Before I start the video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 3-1 question number 3. This is the structured paper 3, which consists of 3 questions. Each of them will be of 30 marks and the total time limit for the paper is 1 hour and 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 3 under 30 minutes. Without any further delay, let's get started. GS PLC is a manufacturing company with a financial year end of 31st December. In 2022, it applied a rate of factory profit of 19%. In 2023, the rate was 20%. And an experienced member of staff prepared draft summarized financial statements for the year ended 31st December 2023 and wrote up the ledger account for the provision for unrealized profit. These contained errors and were as follows. So we have the manufacturing account, it's very summarized. We have the prime cost, factory overheads. We have the increase in work in progress, which is subtracted, that's correct. Then we have the cost of production. Then we added the factory profit in order to get our transfer price. Then we have the provision for unrealized profit account as well. Okay, the opening balance is 13,300, and instead of just figuring out the difference between the opening balance of the provision for unrealized profit and the closing balance, the difference included here is that of the factory profit. So the provision for unrealized profit account is incorrect. Then we have the statement of profit or loss. Okay, the inventories are included at a transfer price, that is correct. We have the transfer price of manufactured goods, all right. We have then the cost of sales, gross profit, administrative expenses, distribution cost, profit from operations, finance cost, and profit for the year. Then we have the statement of financial position as well. Okay, the error here is that we have included the inventory of finished good at transfer price. It should have been included at cost. Then provision for unrealized profit is included here. That should not have been done. And okay, we have some additional information as well. The value of the work in progress at 31st December 2023 had been understated by 2,000. So if our closing inventory of the work in progress was understated, it means that the increase is also incorrect. So we should correct that as well. Let's see, I think we can adjust it to the cost of production. Previously, the increase in work in progress was of 1,700. But if the closing inventory value itself was understated by 2,000, it means that we now have to increase the closing inventory value by 2,000. So this will further increase our increase in the work in progress inventory by 2,000 as well. And we know that the increase in work in progress should be subtracted. So we need to subtract additional 2,000 here. That's for the first part. Then also, whenever we are including the value of the work in progress, it was understated. We also include it within our statement of financial position. So this value should also be increased by 2,000 now because it was previously understated. Then for the second information, depreciation on factory machinery amounting to 10,000 had been treated as depreciation on office equipment. Okay, so the depreciation on office equipment will be included as part of our administrative expenses. So we should remove that. The new administrative expenses will be 51,700 minus 10,000. And this 10,000 is the depreciation on factory machinery, which should have been a part of our factory overheads. Remember that factory overheads is added in order to calculate the cost of production. So we can add the 10,000 here. Alright, that's all for the second information. For the third one, 3 months unpaid interest on the debentures had not been accounted for. We need to calculate the 3 months interest. So the amount of debenture is 200,000. The rate for debenture interest is 7%. This will give us the interest for the entire year, but we only want the interest for 3 months. This results in the value of 3,500. Now we need to include this 3,500 within our finance cost as well because it was previously not accounted for. So the new finance cost will be 21,600 plus 3,500. And remember that this is the unpaid interest on debenture. So unpaid interest on debenture means that it will be part of our other payables. So that should be included as part of trade and other payables. So this value should now be increased by 3,500. Alright, that's all for this information. For the fourth one, a delivery vehicle with a carrying value of 22,000 was found to have a value in use of 19,100 on 31st December 2023. It was estimated that it could be sold for 20,000 but that the selling expenses of 100 would be incurred. Whenever you have been given information regarding carrying value, value in use and fair value, Fair value, in this case, we need to calculate. Fair value is just the estimated selling price minus the selling expenses. In this case, the estimated selling price is 20,000. Estimated selling cost is 100. So the fair value will be equal to 19,900. Now this information belongs to impairment. So we need to check if there exists an impairment loss. In order to check that, we first need our recoverable amount. Recoverable amount will be the higher amount of the fair value and value in use. In this case, value in use is 19,100, fair value is 19,900. Fair value is higher, so that will be our recoverable amount. Then we need to compare the recoverable amount to the carrying amount, which in this case is 22,000. Okay, so impairment loss will only exist when the carrying amount is higher than the recoverable amount. In this case, carrying amount is higher, so there exists an impairment loss, and the impairment loss is just going to be the difference. So that's 22,000 minus 19,900. This results in 2,100. And remember, impairment loss should always be treated as part of our expenses within our statement of profit or loss. In this case, the impairment loss belongs to delivery vehicle. So this expense should be categorized as the distribution cost. Okay, so the new value for the distribution cost will be the previous value of 44,200 plus 2,100. Then whenever there is impairment loss, we need to subtract the amount in order to correctly calculate the net book value for the non-current asset. So we need to subtract 2,100 from our non-current assets given within the statement of financial position as well. Alright, that's all for the fourth information. For the fifth one, the values of inventory in the draft statement of profit or loss were found to not need amending. Okay, so the values given here are correct. Then raw materials valued at 5,000 had been stolen on 4th January 2024. Remember that our closing date is 31st December 2023 and the impact on inventory, the goods being stolen, is on the date of 4th January. So this is after the reporting period. So this is the event after the reporting period, and in this case this will be a non-adjusting event because the conditions for this inventory being stolen did not exist at the date of 31st December 2023. So this does not need any correction within our financial statements, but we do need to disclose this information through notes to the accounts. Alright, that is all for the additional information. Let's take a look at the first question. We need to explain one reason why the rate of factory profit has changed between 2022 and 2023. Let's take a look at our information. In 2022, the rate of factory profit was 19%. In 2023, the rate was increased to 20%. Remember that we apply the rate of factory profit so that we get the transfer price. Transfer price is equivalent to the buy-in price, so it should be comparable. It means that the rate of factory should be set in such a way so that our transfer price will be comparable to the buy-in price within our market. So that is the comparison with other businesses which are trading within the same industry or the same product. Okay, so that's the reason why the rate of factory profit could have increased in this case, so that our transfer price could reflect the buy-in price. Let's write it down. The rate of factory profit is set so that the transfer price reflects the buy-in price to enable true comparisons with other businesses trading in the same product and in this case the rate of factory profit has increased. The rate of factory profit has increased because the difference between production cost and the buy-in price has increased. Alright, that's all for the first part. Now let's move towards the second one. We need to prepare a corrected provision for unrealized profit account for the year ended 31st December 2023. Okay, this is the provision for unrealized profit. Whenever there is the word provision, we can always consider it to be a part of our liability. And whenever we are preparing a ledger account for the liability, we start with the opening balance on the credit side. So in this case, we'll have the opening balance right here, the closing balance right here. Okay, and these two balances will just reflect the profit associated with the opening inventory and the closing inventory of finished goods. In this case, we were told that the values of the inventory given within the draft statement of profit or loss were correct. So this value as well as this value is correct, and in this case, these are the values at the transfer price. Transfer price means that it includes the cost as well as the profit. The opening balance and the closing balance is the profit part. We need to figure that out. And in this case, for the opening balance, in 2022, we applied a rate of 19%. So that will be the rate of profit. So the transfer price will be equal to cost plus cost times 19%. Okay. Now the transfer price for the opening inventory is 83,300. If we take the cost common, that will be cost times 1 plus 19%. So the cost itself will be 83,300 divided by 1 plus 19%. And remember that profit is just cost times 19%. So the profit that we require will be 83,300 divided by 1 plus 19%. That's the cost times 19%. This results in the value of 13,300. This will act as our opening balance within the provision for unrealized profit. Now we just need to repeat the same process for the closing balance as well. And for the closing balance, we are using the information for the year 2023 where we use the rate of factory profit of 20%. So again, if we just substitute the 19% by 20% and substitute this value by the transfer price for the closing inventory, we'll get the profit to be 76,800 divided by 1 plus 20% times 20%. This results in the value of 12,800. Let's write it down. Okay, in this case we can clearly see that the credit side is heavier. It means that we need a balancing figure on the debit side. And this also means that there is a decrease in the provision for unrealized profit. So that decrease should be included under the heading of statement of profit or loss. And always remember, if there is a decrease in the provision for unrealized profit, we consider that to be a part of our income. If there is an increment, we consider that to be a part of our expenses. Now we can get the total from our credit side to be 13,300. Then the value to be included under the heading of statement of profit or loss will be 13,300 minus 12,800, which is 500. Now we also need to show the closing balance as the opening balance for the next period. So that will be balance BD on the opposite side, with the value 12,800. That is all for the second part. Let's move towards the third one. We now need to prepare a corrected statement of profit or loss for the year ended 31st December 2023. Okay, this is the statement of profit or loss for the year ended 31st December 2023. We always start with revenue, and in this case I don't think we did anything to the revenue, so we can still include the previous value. We've already adjusted the information as well, so we can just copy down the amounts that we have here, 681,000. Then our opening inventory and the closing inventory value is correct, so we can just include it as 83,300 and 76,800. So revenue is 681,000. Then we move towards cost of sales. Cost of sales includes our opening inventory of finished goods. So opening finished goods inventory. Then we include the transfer price. And the closing finished goods inventory. We do not need to change the value of the inventories given within our draft statement of profit or loss, so let's include those values. The opening was 83,300, closing was 76,800. Now for the transfer price, remember that we made adjustments to the cost of production. So if there is a change in the cost of production, there will also be a change in our transfer price. So we need to recalculate everything. So we can start with the recalculation of cost of production. That will be 273,200 minus 2,000 plus 10,000, which results in 281,200. Now we can recalculate the factory profit. That will just be 20% of the cost of production. So 20% of 281,200, which results in 56,240. Now we can get our transfer price. That will be the sum of our cost of production and the factory profit. So 281,200 plus 56,240, which results in 337,440. Let's write it down. 337,440. Now we can calculate our cost of sales. That will be 83,300 plus 337,440 minus 76,800, which results in 343,940. Now we can calculate our gross profit. That will just be 681,000 minus 343,940, which results in 337,060. In case of manufacturing account, we need to calculate the effective gross profit by making adjustment for our factory profit and the provision for unrealized profit. So after gross profit, we always add back the factory profit. Then we need to make adjustment for unrealized profit, and that could be positive as well as negative. So adjustment for unrealized profit. Okay, so we've already calculated the factory profit before. That was 56,240. Then we've also prepared the provision for unrealized profit account, and in this case there was a decrement. We've already established that a decrease should always be treated as part of our income, so we will be adding this 500 as well. So the factory profit was 56,240. The adjustment is 500. We will be adding this. Then we can get our effective gross profit. Alright, that will be 337,060 plus 56,240 plus 500, which results in 393,800. Now after the effective gross profit, we can just subtract all of our expenses. So that will be the administrative expenses. And our distribution cost. We've already made the changes, so we just need to calculate the new amounts. Okay, for administrative expenses, that will be 51,700 minus 10,000, which is 41,700. For distribution cost, that is 44,200 plus 2,100, which results in 46,300. Let's write it down. So 41,700 for administrative expenses, 46,300 for distribution cost. Now we can get the profit from operations. So that will be the effective gross profit 393,800 minus the administrative expenses of 41,700 minus the distribution cost of 46,300, which results in 305,800. Now we also need to subtract the finance cost from our profit from operations so that we can get our profit for the year. And there was adjustment to the finance cost as well, so we need to recalculate the correct amount. For finance cost, it was 21,600 plus 3,500, which results in 25,100. Let's write it down. So now the profit for the year will be 305,800 minus 25,100, which results in 280,700. That is all for this part. Let's move towards the next one. We now need to prepare a corrected statement of financial position at 31st December 2023. This is the statement of financial position. This is at 31st December 2023. Okay. And again, for the draft statement of financial position, we've already made adjustments. So we can just copy down the new amounts. For the non-current assets, after the impairment loss, the value for the non-current assets will be 762,000 minus 2,100, which is 759,900. Then the new value for the work in progress will be 9,800 plus 2,000, which is 11,800. And remember, the finished goods should be shown at its cost. So we first write it down at its transfer price. Then we need to subtract the profit associated with it, which we have calculated right here, 12,800. Then we need to show it at its cost, and there was no changes to the trade receivable, so we can still include it at the value of 101,100. Okay, let's finish our asset section. So we start with the non-current assets. After impairment loss, the value was 759,900. Now for the current assets, we first have inventory, and we have three different values. Raw materials, we did not change the raw materials value, so we can still include it at 72,000. Then we have the work in progress. Previously the value was 9,800, but then it was understated by 2,000. So we added the 2,000 back, which gave us a new amount of 11,800. Then we have our finished goods. So we first need the finished goods at transfer price. Okay. The closing finished goods at transfer price was 76,800. Let's write it down. Then we need to subtract the provision. So less provision for unrealized profit. And we've calculated this within the provision for unrealized profit account, which was 12,800. So we need to subtract it so that the finished goods can be shown at its cost. Now let's calculate the total of our inventory. 72,000 plus 11,800 plus 76,800 minus 12,800, which results in 147,800. Then we had one other current asset, which was the trade receivables. Okay, there were no changes for trade receivables, so we can just include the previous value, 101,100. Now we need to calculate the total of our current assets. So that's the inventory plus trade receivables, 147,800 plus 101,100, which results in 248,900. Then you need the total assets. Okay, so the total assets will be non-current assets plus the current assets, 759,900 plus 248,900, which results in 1,008,800. Okay, now we can move towards the equity section. I don't think there were any changes for equity, so we can just copy down the exact same amount. We have the ordinary share capital of 500,000. Okay, there will be changes in the retained earnings because this retained earnings includes the draft profit for the year. So that should be removed, which was 229,160. Then we should include the correct profit for the year, which we recalculated. This one, 280,700. So the correct value for the retained earnings will be 182,760 minus 229,160 plus 280,700, which results in 234,300. So that's all for our equity. Let's write it down. We have the ordinary share capital of 500,000. Then we recalculated the retained earnings, which was 234,300. Now let's calculate the total for the equity. That will be 500,000 plus 234,300, which results in 734,300. Now we can move towards the non-current liabilities. I think there was only one non-current liability, which was our 7% debenture. Let's take a look above. Okay, the amount was of 200,000. Now we can move towards the current liabilities. Okay. For the current liabilities, we made adjustments to trade payables. It should also include the other payables, which was the remaining interest to be paid on the 7% debenture. So the total amount will be 73,500 for trade and other payables. We should not be including the provision for unrealized profit, so that was incorrect. Then we have the bank overdraft of 1,000. So these are the only two items that we need to include under the heading of current liabilities. The first one is trade and other payables. So 73,500. Then the bank overdraft of 1,000. Okay, so the total current liability will be 73,500 plus 1,000, which is 74,500. Now we need our total equity and liabilities. Okay, we have the total equity of 734,300, non-current liability of 200,000, and the current liabilities of 74,500, which gives us a total of 1,08,800. And in this case, the total equity and liabilities is the same as the total assets, which means that our statement of financial position is correct. That is all for this part. Let's move towards the next one. We have been given additional information. One of the directors is concerned that after 10 years of trading, the balance on the retained earnings account is low in relation to the profit for the year. He says that this shows that the dividends paid were too high. We now need to advise the directors whether or not the balance on the retained earnings account is too low as a result of paying excessive dividends. We need to justify our answer. This is a 5 marks. 1 mark for our decision and 4 marks for the comment. Okay. So the first thing we need to see is compare the value of our retained earnings to the profit. So we can see that the retained earnings is 234,300, whereas our profit for the year is 280,700. The first comment we can write down is that the balance on the retained earnings account is less than the profit for the year for 2023. So the balance on the retained earnings account is less than the profit for the year for 2023. Okay. The second thing we can see is that this low balance of retained earnings may not be due to just the dividends. It might be due to the fact that the company made losses during previous years, due to which the balance on the retained earnings account was negative. Let's write it down. This low balance may not necessarily be because of dividends. If the company might have made losses in the previous years, that could also result in the retained earnings balance being lower than profit for the year. And another reason why the retained earnings account could be too low is because the company might have used retained earnings in order to fund a bonus issue of shares. So another reason for the low balance can be that the company might have used retained earnings to fund a bonus issue of shares. Okay, we have 4 comments. Now based on these factors, we need to make a final decision. So I would say that the balance on the retained earnings account is too low, not as a result of paying excessive dividends, because whatever accumulated profit we had over the years might have been plowed back into the business in order to fund the expansions. So we cannot say that the sole reason for the balance being low is due to excessive dividends. Let's write it down. The balance on the retained earnings account is too low, not just as a result of paying excessive dividends, but due to the fact that the profits are being plowed back. It just means that the profits are being invested into the business, in order to fund expansions. Alright, that is all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you are subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.